Hi, this is Randy Finney with the right side of the chart, and today is Monday, September 25th, 2017. I wanted to do an update on the markets, particularly QQQ and the top weighted components, five largest components, which collectively I refer to as the FAANG stocks, FAAMG. That's Facebook, Apple, Amazon, Microsoft, and Alphabet, which is symbol GOOG or GOOL, depending on which share class you're trading. So let's just dive into the charts. This is a chart I've covered many times in the past. This is the QQQ, a 2-year daily chart showing a series of divergent highs and in some cases divergent lows. You have marked down here. And you can see, although the primary trend has been up, there's certainly been a lot of tradable rallies along the way. So again, you can see where the divergent highs are marked, and you see negative divergence down on the RSI and the PPO. And each of these divergent highs was followed by a correction. So it's fairly accurate indicator. And as I always say, the actual sell trigger on negative divergence is not just the divergence in itself, but it's more so a break of a support level. So in this case, with this most recent divergent high, and I've already shared these targets, these potential targets that I have down here, these three levels. We have a pretty clean, well-defined bearish rising wedge. You can see an uptrend line there. We have at least one, two, couple reactions here, a couple reactions here, another reaction there. And most importantly, we're on that support now, or at least we closed on it Friday, I should say. So there's your negative divergence. This is one of the largest divergences that we've had as far as the scope of the divergences. In the last 2 years, but that doesn't always play out for, you can't always predict the amount of the move based on the scope of the divergences. Sometimes we have very small divergence and a larger correction. Sometimes we have pretty large divergence and a minor correction. So take it for what it's worth. It's just good, in my opinion, for helping to identify a likely trend change. And so far, we've rolled off a little bit. We're just off the highs, not by much. So again, watch this level. Here's that uptrend line. Should we make a definitive break below there, especially a daily close, then I think that greatly increases the odds that we're going down to any of these price targets here, at least the 136 level. I do expect a reaction here on this uptrend line. But again, I think the first major reaction will come on a move down to 136. And if you're just a short-term trader looking to game a little a short-term pullback, I also see some support here around 140.83. You can see a couple reactions there, and that'll come in with that trend line as well if it took us a little while to get there. Just a quick look at the weekly chart. Always want to keep the big picture in mind. As most of you guys know, this is one of the longest bull markets in history, and it continues to chug on. Does show there are some divergences here. We've had divergences along the way. This is a 10-year weekly chart again. So we've had divergences which have played out for corrections, but forget about all that. For now, let's just watch. This is the more significant. This is the uptrend line off the 2015 lows right here. You can see quite a few reactions, very well defined. And, from my experience, the better defined a trend line is, meaning the more reactions along the way, the longer it is with a lot of reactions, the more significant that is as a support level. So the big takeaway from this is if the near-term targets, if that rising wedge I just covered on the daily chart plays out and breaks down, we head down to those targets, that will most likely be the catalyst for this more significant breakdown on the weekly time frame. So what you want to see here is a weekly close below that uptrend line, and that would have longer-term bearish implications. Just looking at this chart, I could easily see the potential for move all the way back here to the 120 area. And we're at 144.32 right now, so that'd be a pretty decent drop in the Qs. So again, let's just watch for it, see what happens. But the potential is there in the charts for a much deeper correction than those near-term targets that I showed you here on the daily. Okay, starting out here, let's just look at the FANG stocks and then we'll wrap this up. Apple, I've pointed out in the last few weeks, even before this bearish rising wedge pattern broke down, that was pretty likely. It was all there in the charts. You can see, pretty clear negative divergence, clean and powerful negative divergence, excuse me. This small bearish rising wedge back here with a divergent high, that was good for a 12% correction. So far off the highs, Apple's fallen about, almost 8%. And we I pointed this out last week. We took out the 154. That was my first target. That opens the door here for a move down to about 148.20. And then at the very least, I see before all is said and done, meaning there'll probably be some counter trend reactions. We're certainly getting oversold near term, but I think Apple works its way down to 142. And from there, we'll just have to take it as it comes, take a look at the charts, look to see if there's any divergences or anything bullish setting up on the intraday charts. Otherwise, if we break that 142 level with conviction, we're probably headed all the way down here to this gap target zone right here. It's pretty thin on the volume price histogram, so I think the potential is there for a deeper move, but at the very least, I'm looking for another about 6% or so downside in Apple, again, before all is said and done. Um, this is a weekly chart, and this again sort of aligns with what I was seeing on the QQQ chart. I could draw a trend line here, and I probably should add that right there. There's an uptrend line on Apple. What stands out the most are these divergences, the RSI in this instance. We have the PPO as well shows a divergence. I should clarify right now we have negative divergence. You can see it here on the PPO. You can see it on the RSI. Now in the RSI in the past, 70, this red line is considered overbought. The 70 level on the RSI. However, I added an extreme overbought level, and I've covered this in the past. That line's about 77. And Apple's only hit that. This is a 10-year weekly chart, so only a few times, handful of times, I should say, in the last decade. And what happened is every time we hit it, we came back up, made an equal or lower low, i.e. negative divergence, and those were followed by corrections. This little one may not look like much. That was a quick drop, looks like a flash crash, and that was about 27%. So remember, I use log scaling on these charts, so when you're looking at a 10-year chart of Apple, don't underestimate the scope of these moves. If you put a arithmetic chart, it looks a little bit different, but it gets ugly, so I like the log scaling. So there it is, divergent high, extreme oversold, I'm sorry, overbought, extreme overbought, came back in, pushed up, made another overbought reading, and that was good for a 45% drop. Fast forward to late 2014, extreme overbought, and we continue to become overbought. Remember, the red line is the traditional overbought level, the 70 level. And so, like many tops, it's not on that initial, especially in a bull market. Different in a bear market, but in a bull market, it's usually not the first overbought reading that really marks a tradable top or a near-term top. It's a second lower overbought reading. In other words, you get that negative divergence with prices making a higher high against the indicator making a lower high. And that was the case there, and that one was good for a 32, actually more. I was calling for a 32% drop and saying more likely to come, and we did get more. I can measure it out for you if I can grab that level roughly. This is just a rough measurement, about 33, call it a little bit more than 32. So then we had a nice, these lines here show a bullish falling wedge. We had positive divergence. You can see it there as well in the PPO, and that sparked this huge rally. We had a breakout and a back test, and that was bullish. Now, I will say that wedge has more than met its measured target. The widest part of this wedge, if you add it to where we broke out right here, we've certainly met the measured move for that. So, that's one thing that says this rally isn't going to go forever if you're going by, the pattern measurement on that falling wedge. But more importantly, fast forward to today, and we have again recently back here, we had another extreme, one of those rare extreme overbought readings. In fact, this might have been, was close to this one right here that preceded the 45% drop. This was one of the most extreme overbought readings on the weekly chart. It was a RSI reading of about 85 right here. And since then, Apple pulled back, made another thrust up, as it's always done in the past, put in a lower overbought reading. And this one was actually almost hit the extreme level again, about 75, so well above the 70 level. So there's a uh, lot of factors in the chart that show me that not only a correction in Apple is likely, but a significant correction. By significant, I'm talking 20% or more. The potential is certainly there, and we'll just have to monitor the charts, as I said, and see how they play out. So that's Apple. Spent a lot of time on Apple, as I should. It's the largest component of both the QQQ as well as the S&P 500. Let's look at Alphabet. Alphabet has such a long-term trend line. I have to jump back here to this 2-day period chart that spans 4 years now, and you can see this trend line. This chart's a little bit busy, I will admit. Let me see if I have a cleaner version here. Okay, looks like I do. This is, again, this is a 2-day, so a 4-year chart. Every candlestick is 2 days. And you can see the negative divergence here, long-standing divergence. And more importantly, we have this the recent steepening, or this negative divergence here. You can see from this high, Alphabet's essentially made about a double top high, roughly equal highs there, with a steep divergence in the RSI and the PPO down below. And so far that's started to play out. Now here's a big, very significant gap right here back from looks like in early May, late April. So that's going to be support. Watch that level. So we have pretty key intersecting support levels here on Alphabet. We have the uptrend line that goes all the way back to mid 2015, as well as a pretty significant gap. So you can see how that gap, if we look closely, has been tested from above several times already. So watch to see what happens. If we break this trend line, we're going to go down, test the top of that gap again. Most gaps are backfilled sooner or later, so maybe we go into backfill it, and this will be the important level. Do we just backfill and then off to the races? Maybe. That would be one possible scenario. I mean, there's a lot. I can't draw them all out here, but just look to see what happens with that gap. If it's successful, maybe we come all the way back up here and back test the trend line from below and continue lower. Maybe that's all there is, and we move back up higher and take out the previous highs. However, if that gap goes, the bottom of the gap goes with conviction, we've already lost that trend line. That would be pretty bearish and speak to the longer term bearish case in Alphabet. And as we move on to Microsoft, as you can see, the charts are a lot, very much in alignment. Now, these are all different companies with different business models, but their charts, because they're all top weighted components of that QQQ, and that's where the money's been going throughout this bull market into ETFs and indexed funds. And you can see how they tend to all these key technical levels line up. I showed you a lot of these companies, I'm sorry, Apple and Google so far at support, QQQ at support. And here's Microsoft. This is a pretty significant trend line from mid 2016 right here, the white trend line. You see quite a few reactions on there. And this line above forms a bearish rising wedge. So you can see Microsoft in a wedge. That wedge is confirmed, as I like to see, with negative divergences. So by all accounts, I see more downside, especially when this trend line breaks. Now again, just like QQQ, we're at support, and support is support until and unless broken. So let's see what happens here. Let's look for a break. Ideally, you want to see an impulsive selling on the breakdown. That's increased volume, pretty large red candlestick, and of course a daily close. Now I have some minor trend lines that I've added here as well. We'll watch these, and you can see some levels on the chart. So there's Microsoft. Facebook, same story, negative divergence, very steep divergence here on this most recent high. We have almost an equal high in prices. However, you have a pretty sharp divergence down here on the PPO and RSI. There's a trend line here. This line with this upper trend line forms what looks like a very large, kind of extended, ascending, broadening wedge pattern. But either way, let's watch to see what happens. You can see horizontal support right around here, and I would expect a reaction on this trend line if it's visited once more. But ultimately, this is my swing target down here. And I put a question mark drop because it's an older chart. From here to just try to give you an idea, that would be about a 16% drop in Facebook. And then last but not least, Amazon. Um, I've covered this one recently as well. There's these blue lines. Forget about everything else. Focus on the blue lines. You can see a large wedge pattern, a little wedge overshoot at the top. That put in a divergent high. You can see the divergence right here on the PPO and divergence down here on the RSI. We broke down, and so far we haven't seen impulsive selling, and one reason for that is you remember these stocks are going to trade together because they're indexed so heavily. So until you see impulsive selling in QQQ, it's very unlikely you'll see very impulsive selling or very large move in any one of these top 5 stocks. However, we have broken down and we're well below the uptrend line now. And you can see this is a support level down here about 925. So if 925 goes, next stop down here I have is around roughly 845, and that'd be a pretty decent drop in Amazon. So let's just take it from there. That'd be about an 8% drop. This is the measured target of the that wedge pattern. You just take the widest point, and you add it to where the pattern broke down, and that's the if things get ugly target. So we're not there yet. A lot of work to be done. Weekly charts, all the trends are still bullish there. So we'll just have to take it as it comes. Oh, before I wrap up, one other board on Amazon, another chart that I have drawn up. There's the wedge. It's a lot cleaner there. I think you guys can see it there. Here's the negative divergence at the most recent high. You can draw it any way you want. You can include that overshoot or exclude it. Either way, it's a divergent high. One of the first divergent highs we've had in a while. Last one I see, just looking at this chart, didn't mean to hit the note button. Tried to grab a trend line tool. Back here, you can see yeah, negative divergence there, negative divergence there from this point here, and you can see that big drop in Amazon. That was good for about a 15% or so correction. The other thing I wanted to point out is the PPO. I like to use the MACD or the PPO as a trend indicator, focusing on the signal line, the 9 EMA right here, the white line. Uh, Grab the wrong tool again. There it is, 9 EMA, which is the white line, last of the two to cross. So you can see when that line is above zero, the trend is bullish, and when it's below zero, as it was right here, the trend is bearish. Pretty simple yet effective. We crossed back above right here. It kept you long throughout it, that entire trend, and told you that after this crossover here, the trend was bearish, and it remained bearish for a little while there. So it captured the bulk of that downtrend, that correction. And so again, remember, we're looking at a 2-year chart. So throughout that 2 years, while Amazon's been in a primary uptrend, that PPO for the vast majority of the time was above the zero line. The zero line often acts as support when tested from above. It keeps the trend, reaffirms a bullish trend. But once it breaks below, so we've only had these white arrows show only 3 crosses in at least the last 2 years. Each of those previous crossovers resulted in, it signaled the biggest corrections that Amazon's had in the last 2 years, and we are now and have been. We crossed over here recently. Here, I'll zoom in for you, so you can see back here we had a bearish cross with that signal line right there where the crosshairs are. And it remains below the zero line. You can see how well this works. We come back in, and it's amazing how well these trend indicators, you know, effectively work here. You can see the PPO line. Now that crosses above, but I ignore that one because that is the faster line. That will cross over. That will give you a lot more whipsaw signals. That's why I use the second line. And you can see the PPO line has rolled over. It's now made a bearish crossover, meaning the PPO line has crossed down below the signal line right as the signal line came up and to test that zero level. And usually when you get a bearish cross like this of the pair, you're headed lower. So again, I want to just point that out that not only has Amazon been trading below that primary uptrend line for a long time now, too long to say that was a whipsaw signal, yet really not a sharp correction, at least not commensurate to the scope of this pattern. However, again, the trend remains bearish, so if the Qs roll over and you start to see a lot of selling, and you can put a little line there, you can see, gosh, I'm just grabbing wrong tools left and right today. There it is. You can see the support right there. That's about 138. I'm sorry, 938. So look for a break of 938 on Amazon, and that should bring us down to the next target. All right, this has been Randy Finney with Right Side of the Chart. Hope